Every other video and textbook can show you how to do the indirect method, how to add this back, how to subtract that, and so on. But do you really know why we do these adjustments the way we do before learning how? Hi there! If you're new here, my name is Joe and welcome to this video on cash flows from operating activities using the indirect method. Our goal today isn't just to memorize a list of additions and subtractions. It's to understand the fundamental accounting logic behind each adjustment so that the indirect method finally makes sense. We're going to peel back the layers of accrual accounting to reveal the actual cash flow from operations. Let's dive into the core problem, the difference between net income and cash flow. The root of all the complexity in the indirect method is the difference between accrual accounting and cash accounting. As accountants, we know net income is calculated on the accrual basis. This means we record revenues when they are earned and expenses when they are incurred or matched to those revenues. Okay, the timing of the actual cash exchange is irrelevant. Okay, however, the statement of cash flows is entirely focused on the cash basis. It only records revenues when cash is received and expenses when cash is paid. Because of this timing difference, net income rarely equals cash flow from operations, which is why we need to reconcile the two. This is the core problem the indirect method solves. Okay? The indirect method of presenting this section starts with our accrual-based net income and then applies adjustments to eliminate the non-cash effects, finally giving us the net cash flow from operating activities. Since we now understand why net income and cash flow differ, let's look at the two approved formats for presenting the operating activities section. First, we have the direct method. This method reports the components of cash flow as the actual gross cash receipts and gross cash payments. Okay? It essentially restates the income statement on a cash basis, showing figures like cash collected from customers. Second, we have the indirect method. This is the one we are focusing on because it starts with net income and then makes various adjustments to eliminate all the non-cash accrual effects. Think of it as a reconciliation statement. The most important takeaway is that both these methods always arrive at the exact same final net cash flow number. Okay? They're just different ways of presenting the same figure. Virtually, all US-based companies choose the indirect method. They prefer it primarily because it's less costly and easier to implement than the direct method. So let's now dive into the mechanics of this dominant method. To truly appreciate the indirect method, we need to understand exactly why every line on the income statement distorts the cash flow picture. As this slide illustrates, the entire income statement is an accrual engine built on timing differences. We use the indirect method to systematically unwind all of them to get to our cash figure. Look at the first few lines. Sales revenue is recorded before the cash is actually collected, creating accounts receivable. Cost of goods sold and selling and administrative costs are recorded before we pay our suppliers or creditors, tying them to accounts payable and accrued expenses. Every one of these operating lines requires an adjustment because the money recorded on the income statement is not the money that actually flowed into or out of our bank account during the same period. Okay? And then you have the non-cash item, depreciation expense. It reduces net income but has zero effect on current cash. The entire statement is full of these accrual effects. Because net income is the summation of all these timing differences and non-cash items, the indirect method is essential to systematically unwind all these accruals and reveal the single correct cash flow figure. Let's now look at the step-by-step procedure to do just that. Now that we know the indirect method is a reconciliation, let's look at the step-by-step roadmap we'll follow to convert net income into cash flow. Think of the slide as a checklist for any problem you solve. Okay, we begin logically with step 1. Okay, you start with net income from the income statement. This is our starting point for the entire reconciliation. Next, we handle the non-cash timing issues. Step 2 involves adjusting for non-cash expenses like depreciation and amortization. We'll soon see in detail why we add them back. Step 3 is adjusting for non-operating gains and losses, specifically those related to selling long-term assets. Okay, we'll break down the logic of adding or subtracting to ensure we don't double count cash flow that actually belongs in the cash flow from investing activities section. Okay, Finally, the bulk of the work is in adjusting for changes in working capital accounts. Step 4 is where we apply the inverse rule to all changes in operating assets. And step 5 is where we apply the direct rule to all changes in operating liabilities. After performing all 5 adjustments, the final result is our net cash flow from operating activities. Let's now walk through the steps and look at them in detail. We are now beginning our reconciliation process, starting with the first 2 actions on our roadmap. Okay, step 1 is simple. We start with net income, shown here as our bottom line, right? This figure should be converted to a cash flow number. Okay, step 2 is our first critical adjustment, dealing with non-cash expenses like depreciation and amortization. Okay, look at the income statement snippet here. Okay, we subtracted $10,000 for depreciation along the way in our calculation of net income, right? Okay, this reduction is what we need to reverse now. Okay, the logic behind this is the following, right? This depreciation expense reduced our net income, but it did not reduce our cash. The cash was spent years ago when the asset was actually purchased. Okay, to reverse the non-cash reduction and find the true cash flow, we must add it back to net income. Okay, a quick side note on taxes if you're concerned. While depreciation did reduce our taxable income and therefore reduce the cash we paid for taxes, okay, that effect is already accounted for within the income tax expense line. Okay, for the purpose of this simple adjustment, we just focus on the non-cash nature of the depreciation itself and perform the full add back. Okay, the simple rule remains that if it was a non-cash expense, you add it back. Okay, our next adjustment, which is step 3, deals with gains and losses on the sale of long-term assets. Okay, let's use a numerical example again to figure out the why. Okay, we make these adjustments primarily to prevent double counting the cash flow. If a machine with a book value of $6,000 is sold for $8,000, let's say, we recognize a $2,000 gain. Okay, this gain increased our net income, which is our starting point, right? Okay, since the $8,000 in cash is already counted in the cash flow from investing activities section, and only $2,000 of that is inflating our net income, we must subtract the $2,000 gain from the net income in the operating section, okay, in the cash flow from operating activities section. This removes the non-operating revenue. Okay, the opposite logic applies to a loss on a sale. Okay, if the machine had sold for less than $6,000, then the resulting loss would have decreased net income. To reverse that negative non-operating effect, we would add the loss back. Okay, we are essentially ensuring that net income only reflects operating items before we move to the final adjustments. Now we move on to steps 4 and 5, which is where we deal with changes in our current operating assets and liabilities, also known as working capital accounts. Okay. Step 4 of our roadmap deals with adjusting for changes in our operating assets. Let's jump straight into an example using accounts receivable to figure out the rule. Okay, this is the logic behind the inverse adjustment. Imagine our accounts receivable started the year at $1,500 and ended at $1,000. Okay, our income statement reported $40,000 in sales revenue. Okay, our accounts receivable decreased by $500. Now ask yourself, if accounts receivable went down, did we collect more or less cash than the revenue we reported? A decrease in accounts receivable signals that we collected $500 more cash from customers than the sales revenue we reported on the income statement. Okay, since net income already includes the $40,000 revenue, okay, we only need to account for that $500 difference. Okay, because we collected more cash, that $500 must be an increase in cash flow. Therefore, we add the $500 decrease in accounts receivable to the net income. This leads us to the fundamental rule for all operating assets. The relationship is inverse. Okay, if an asset balance increases, we subtract that amount from net income. And if an asset balance decreases, we add that amount back. This inverse rule applies to all key operating assets: accounts receivable, inventory, and prepaid expenses. Okay, now take a moment to apply the same thought process to the other items. If inventory increases, does that mean we paid more cash or less cash than the cost of goods sold reported? Think about that as we look at the next set of adjustments. Now we look at the final part of our reconciliation, Step 5, dealing with operating liabilities. The relationship here is the opposite of assets. The rule is direct. Okay, let's jump into the accounts payable example to understand why this relationship is direct. Imagine our accounts payables started the year at $1,500 and ended at $1,000. Okay, the relevant accrual expense, let's say, was $20,000. So our accounts payable decreased by $500. A decrease in accounts payable signals that we used $500 more cash to pay down our balances than the new expenses we incurred during this period. Okay, essentially we had an extra cash outflow. Since net income has already been reduced by that $20,000 expense and we paid $500 extra cash now that wasn't reflected in that expense, we must subtract the $500 decrease in accounts payable from net income. This leads us to the fundamental rule for all operating liabilities. The relationship is direct. If a liability balance increases, we add that increase back to net income. And if a liability balance decreases, we subtract that decrease. This direct rule applies to key operating liabilities like accounts payable and accrued expenses. We have reached the end of the reconciliation process. This slide brings together everything we've covered into one powerful summary table that you can use as a reference tool. Okay, as you look at the table, notice the clear logic. The entire method boils down to reversing the distortions caused by accrual accounting. The non-cash items like depreciation and losses on sale are added back because they reduce net income but not cash. The non-operating items like gains on sale are subtracted because the cash is counted elsewhere. And most importantly, look at the working capital accounts. Remember the two rules: assets are inverse and liabilities are direct. Okay, if an asset increases, you subtract that increase because an asset increase means you recorded more revenue than you collected in cash. If a liability increases, you add that increase because a liability increase means you recorded an expense but paid less cash than that expense. On a side note, instead of looking at individual assets and liabilities, you can also view this process through the lens of working capital. Okay, remember that working capital equals current assets minus current liabilities. Okay, you can calculate the change in working capital first and then apply a single simple rule. If working capital increases, which happens when assets increase or liabilities decrease, it means cash was used or tied up. Therefore, you subtract the increase from net income. If working capitals decrease, which happens when assets decrease or liabilities increase, it means cash was freed up. Therefore, you add the decrease back to net income. This working capital approach is an advanced analytical technique, but it confirms the logic of our individual rules, right? So when you approach a cash flow statement problem with this mindset, understanding the why, you won't have to memorize a single rule. Okay, you can derive the adjustment every single time. This final result, the net cash flow from operating activities, is the one true cash figure derived from your core business operations. It is the same number the direct method would have produced too. Okay, the entire indirect method is simply a logical, systematic way to move from the accrual-based net income to the true cash generated by your operations. Okay, we have covered all the rules and the logic behind that, but now it's time for the ultimate test. We need a comprehensive example to prove that these rules work in a realistic scenario. Okay, this is how financial analysts actually work. They take the comparative balance sheets, that is the balance sheet from the beginning of the year and the balance sheet at the end of the year, and combine that data with the current income statement, okay, in order to construct the cash flow statement. On this slide, you see our complete set of inputs. Notice that the balance sheet is properly balanced adhering to the fundamental accounting equation. Okay, we've included the full income statement for context, showing how we arrive at a net income of $75,000. Okay, to solve for the operating activities section, we only focus on the net income, the difference in our operating assets and liabilities, and the non-cash, non-operating items like depreciation and gain or loss on sale. Okay, the change in these accounts shown in the delta column, okay, is the key number we will use for our reconciliation. We are going to use the data presented here to calculate the final cash flow figure in the next slide. Okay, here is the final reconciliation where we put all the rules into practice to find the net cash flow from operations. Okay, we start with our net income, okay, of $75,000. This is our baseline, okay. First, the non-cash and non-operating items, we'll add back $15,000 for depreciation, and we'll also add back $4,000 for the loss on sale, okay. Next, the assets, okay. We subtract the $5,000 increase in accounts receivable and the $1,000 increase in prepaid expenses, because these increases mean less cash collected or more cash spent than the accrual items, okay. We also add back the $5,000 decrease in inventory because it freed up cash, okay. Finally, the liabilities, we subtract the $2,000 decrease in accounts payable because we paid down more debt than we incurred, and that costs cash, okay. We add back the $3,000 increase in accrued expenses because we incurred an expense but preserved cash by not paying it yet, okay. After performing all these adjustments, we successfully reconcile our net income to a net cash flow from operating activities of $94,000. Okay, this final figure reveals the true cash performance of the company's core business. All right, we are at the very end of the session, and this slide brings everything full circle to prove the core concept we established earlier. Okay, we worked rigorously through the indirect method and arrived at a net cash flow from operating activities figure. Okay. If we were to complete the direct method, we would arrive at the exact same final figure. Okay. The direct method ignores the net income and calculates the cash flow by converting each accrual-based income statement item into its cash equivalent. Okay. For instance, to find collections from customers, you take sales revenue and adjust it for the change in accounts receivable. Okay. Similarly, to find payments to suppliers, you adjust cost of goods sold for the changes in both inventory and accounts payable. Okay. This complex process shows that the indirect method's simple rules are simply a shortcut to achieving the same result as this full line-by-line conversion. But both methods fulfill the requirement of the statement of cash flows, identifying the one true cash figure generated by core operations. Alright, thank you so much for watching. I hope you found this explanation helpful and informative. I'd like to invite you to check out my comprehensive 12-part free course on financial accounting, available right here on YouTube. Okay, the link to this course is provided below in the video description. Okay, this course covers a wide range of financial accounting topics in detail, and it's a great way to build a solid foundation in the subject. And finally, if you want to expand your knowledge of accounting, finance, economics, math, statistics, and other related areas, I invite you to subscribe to my channel. You can also visit my website, jofusser.com, for additional resources and materials. Okay. Thank you again for your time, and I hope to see you in the future videos or on my website. Cheers.